We've got a huge number coming out in just about a minute. One little change in the narrative can change everything. Let's break this down. I think watching this hourly candle and seeing how it closes will be very telling.
Overall trend of wage growth is declining,
but now the market is bouncing back again.
We've got PMI numbers coming out in 10 seconds to go here. We've got a huge number coming out in just about a minute. Please be careful. Please do not, over leverage. I know a lot of people are tempted to make very rash decisions on days like NFP. So that's the reason why a lot of people don't trade it, is because they make gambling-like decisions. But we'll be watching it here. Again, do not go away. A lot of times people leave right after the spike. Like I keep saying, the opportunity of NFP is not the spike, it's the aftermath. And that's what we're going to be getting into here in about 30 seconds. We'll be taking a look at that. But again, all of these charts we will loop back to. We'll talk a little bit about gold post-reaction. We'll take a look at the S&P. I am looking to see if we can get a hotter jobs number, but more important for me today, I'm really watching this wage growth number. This is what really matters to me, is the average hourly earnings. Does that tick higher? Does it stay the same? Does it tick lower? And that's what the market is likely to look for as well in relation to the Fed. NFP coming in, breaking news. Let's see what we got here. And gold dropping, euro dropping, dollar jumping, S&P down, lower here now, dollar index trading higher, S&P bouncing, but gold dropping still hard. Euro still, look at that drop on the euro. That is an impressive drop there. Let's see if we can get some numbers in. We're still pending. There it is. Non-farm employment change, hotter than expected jobs. Unemployment rate actually went down, and the average hourly earnings is up. Ooh, this is actually a little troublesome for the markets here today. This is looking a little bit like a hotter than expected economy read. And why is that bad for stocks? Well, it might mean that the Fed's chances of rate cuts in March were a little bit presumptuous, a little bit optimistic. And if that is in fact the case, that's why we're seeing stocks drop. That's why we're seeing the dollar index jump a lot. And actually, that might have been a key breakout for dollar bulls here today. So let's go take a look specifically at the dollar index and see how price is looking here in the post reaction. So again, that level of resistance that we were looking at, not seeming like it was going to hold here now. So big push to the upside, and congrats. If you are a dollar bull, then congrats. It's a nice move. I mentioned, and I'll stay true to my game plan, if this level is able to close above this level of resistance, I think there's a good shot that bulls have control for a short period of time and could actually extend up to the 104 level. But we're watching the candle here. This candle, by the way, will go down to like an hourly candle. I think watching this hourly candle and seeing how it closes will be very telling. So if we can get a close on this hourly candle above this key level of resistance, that's going to be short-term very bullish, I think, for the jobs. I'm sorry, for the dollar. Again, resistance breaking out. I would say it is sort of confirmed if you get a closure above this level, because of course this could wick back the other direction. But from what I'm seeing in the jobs number, this is looking pretty, I would argue, pretty strong for the dollar in the short term. Let's break this down. Let's talk a little bit about this number and why it is so significant and why the dollar is moving higher. So we'll keep it really simple, okay? The number of people that got, or the number of jobs created was higher than the forecast. So jobs growth, really good. And then the next one is people who filed for unemployment, or the unemployment percentage here. 3.8% was what was forecasted. That was actually expected to go up. And we got a flat read, meaning unemployment did not go up. So it was better than forecasts. And finally, guys, you have average hourly earnings up to 0.4% month over month compared to 0.3%. People are getting raises. Now you might say, oh, that's great. That's great for the people. And for the people who got raises, and of course, that's great. But for the actual read on the economy, that is showing a strength in the economy, but that strength is not good for the Fed's mandate of wanting to get inflation under control. If average hourly earnings are growing, that is inflationary. Remember, inflation is the idea that prices are going up. If everyone's getting raises, that contributes to prices going up. That's not what the Fed wants to see. And that's, of course, why we're getting a little bit of a reaction here to the upside on the dollar index. Now, again, spiking above resistance, the question will be if we can actually hold that.
Want to stay up to date with all the latest trading information? In the description below, you'll find the link to join our free Discord. The Discord gives you instant access to lots of helpful material like free trading courses, chart analysis, updates about what's happening in the A1 community, as well as discount codes for our other products and services. The best part, all of this and more is 100% free. So go down in the description below this video and check it out for yourself. If you're interested in upgrading to the full VIP Discord featuring our team of expert traders signals, you can use the live chat link in the description to get connected with one of our team members in seconds. So don't wait, go check out the free Discord today.
So I think that what is a little concerning for me here is that, you know, the people are employed, jobs are being granted, and wages are going up. And the issue, I guess, supposedly there would be that, you know, if you take that at face value, that's a little troublesome for the indices. However, there's another side to this, Kenzo, that I think is really important to mention. You know, over here at the turn of the year, there was like nothing to stop the NASDAQ bulls. There was no concerns. The Fed was talking about rate cuts. The economy was hanging in there. Companies' earnings were better than expected in many ways. Forecasts were just fine. And the issue with that is that when everything is so perfect, Kenzo, it actually becomes like it's hard for me to buy anything, because it's like the prices are so high and everybody is so optimistic that one little change in the narrative can change everything. And that seems to be what we're getting now. A little bit of concern that perhaps prices were overextended and that rate cuts, while they still are likely to come, it's possible that the market got a little too excited about it. So I actually am liking this in terms of an index position to give me those pullbacks that I've been looking for. So I'm glad to see some pullbacks on like the NASDAQ. Of the indices, which ones are you watching going into 2024?
Yeah, Nasdaq is the one, and I also liked that pullback. To me, I was waiting for the market to reach this level because we never had any proper reversal, and I think just because this NFP is not really that aggressive, I think we might start to see another push to the upside. So yeah, to me, I'm expecting to see a continuation of that uptrend. I don't know if maybe they will still entertain the thing of cutting the rates, but I think they're gonna stick with that. But I don't really expect it to happen now. But that is something that is still going to fuel the market to push on this uptrend.
Yeah, and I think you know, that's worth mentioning too. Even though you know, you're seeing some bear case come back into the market. It's not that the bull case is dead. It's just that now there are bears at the table. And I think that's actually you can visualize that. I pointed this out, especially in particular respect to the stock market. We've got this new indicator that's pretty cool. It's the AAII Investor Sentiment. This is, of course, a survey sent out to stock market investors specifically. But it gives us a market sentiment read. And it's very, very useful because as we were talking about, Kenzo, you can see that towards the end of the year, bullish sentiment reached like high levels. And then now we are actually starting to see a little bit of cooling in that. We actually got the latest survey result yesterday. So we're seeing, you know, overall risk sentiment, you know, people are still very bullish, but not quite that 53% or 52.9% bullish reading, and only 20.9% people bearish, you know, the week leading up to Christmas. So I think that this is a useful indicator to keep an eye on. And I actually am glad to see that sentiment is normalizing a little bit. As I mentioned, it's hard for me to be super bullish on indices when everyone kind of already is. I made the point earlier that if everybody is already bullish, who is left to buy, right? You have to kind of have some bears in the table in order to get those nice moves higher. So will be very interesting to see on that front. What do you think, Kenzo, about gold? This is the next topic I wanted to ask you about. What do you think about metals right now?
Yeah, I think metals. I saw another article about, it's not gold, but I think it was copper. But mostly they were generalizing about the metals, that this year we might see the prices going up, including gold. So I think that might be something, they might be right, because what I see is most countries who are producing those metals, they are also looking for lower rates, and at the same time, most people, they're going to invest in stuff like gold, silver, and the other ones. So I'm still bullish. For now, actually, this year I'm just expecting that to be right, but I'm just bullish mostly. I think even if maybe we don't really see some crazy cuts off, but I don't really see them increasing the rates, and that might be positive for other stuff that go against the dollar.
Yeah, and I think currently the only thing that I see that would be like really bearish for metals would be what you mentioned, a sudden very high increase in inflation, in which the topic of rate hikes comes back into the scenario. I think that that's not likely to happen. However, overall, I think that the story of rate cuts is still intact, but like I said, today's jobs numbers, a little bit of a pushback on that concept. I've got the 4-hour chart pulled up as well, and you can see I'm a little bit more zoomed in. Look at that rejection candle at that 2030 level. Price came right in, or buyers came right in, it seems, and are holding that level. The question now, I guess, for price action wise on the lower time frames here, I mentioned this earlier, if I'm going to be bullish, for me, it would have to kind of actually be able to break and give us a higher high on this 4-hour chart. But we'll have to watch that. But that is a really impressive rally there on gold here.
Yeah,
following the news.
And that should tell us something, because most likely when we release the like NFPs, if indeed it was like aggressively negative, most likely we see gold is number one to react aggressively. But now we don't even have an hour after the news, but now the market is bouncing back again. That should tell you something, that people don't really care much about that. Maybe CPI next week might tell us a bigger picture, but I think everyone is so bullish. The bearish that we see now, it's the end of the year. Some people, they're cashing out their cash, billions, by the way, so that we should push the market to the lower side. But besides that, I don't really see any aggressive negativity in the market currently.
Yeah, it will be very interesting to watch gold as we go forward. I think there is also something that is worth mentioning. I made a whole video about this, and I think that my video on this topic will come out on Saturday. It's the concept of the Treasury yield curve, and the reason I bring this up is that when you get these yields, these rate extensions, what has historically happened is, to follow, there is a recessionary period. Now, however, let me preface this with the idea that this can take some time to materialize into a recession. And I'm not saying that 2024 we're going into one, but what I am saying is that in the last several occurrences where we've gotten an inversion in the yield curve, essentially saying that people are preferring long-term bonds dramatically more than short-term bonds, when that has happened historically, when we've come back out of that inversion period, we've entered into a recessionary period. In all of these cases previously, 2020, 2008, we had a really big one, right? And 2000, we had the tech bubble that was horrific for the Nasdaq. The point I'm trying to get at with this is that this can take some time to materialize. Just because it becomes inverted does not mean it is instantly going to go into a recession. In fact, the indicator that's a little bit more accurate is when we come out of inversion, and this could actually be an interesting thing. The reason I bring this up in relation to gold is that, of course, recessionary periods can actually be really positive for gold, as fear is oftentimes a strong bullish catalyst for gold going into a recession. So if we do start to see something like that change, and that's why we will be moderating and watching yields quite a lot this year, is that change in pace could be one of those really big risk off, scared sentiments in the market. But I don't know, Kenzo, I just thought that chart might be worth mentioning. And look how
Yes, yes.
crazy inverted we actually are right now. And that is, of course,
No, it's
telling-
aggressive.
yeah, we're in like the worst bond market sell-off that we've ever seen in the U.S. history. So it's historic times for sure.
I am still, I would say, bullish, just because. So NFP beat, and earlier in the week I was saying good jobs numbers is good if we can see, a halt in inflation, and that's what wages did today. They stayed at 0.4% month over month, and they haven't really moved too much for the past several months. So I think better jobs numbers is good for obviously for the economy, but for the stock market too, as long as inflation is not moving. And that seems to be the case for now. And I'm not necessarily overly bullish or bearish on this, but I still have my bullish bias on the markets. And up here is wage growth. You see the past several months have been either at 0.4, 0.2. So really not a lot of movement. Overall trend of wage growth is declining though, which is what I think the Fed wanted. NFP is kind of doing the same thing. This is over the span of 1.5 years or something like that. So still kind of the same trend. I think it was a decent number to be pumped out today, and I'm not really changing my thesis about how I feel about the market. So one thing I do want to mention though is I did get stopped out of gold, and I do want to reattempt at a long trade, just because of just how this bounced right off that trend line, and the 4 hours looking kind of strong. So I'm going to keep looking at gold, and especially if you can't really tell if the recession has been priced in or not in the stock market. For gold, it's kind of different. It's kind of bullish in both of those ways. So like whether the Fed decides to be more dovish, it's going to be good for stocks and gold. But if there is a recession that's still looming, if there is one that has yet to come, gold is still that long play. So I still like gold. If it breaks under this trend line though, it's going to be tough to keep looking for long plays until you get down to like the 1970s, which is under the 2000 mark. So I think for now I'm going to keep looking at gold long plays and focus on that more.
Frank, you made a point there that is perhaps overlooked sometimes, but so important. I pulled up a chart to try and help, because you made the point perfectly, but for those of you who didn't quite grasp what he was saying in the visual format, this might help. Okay, so if there's a recession, inflation likely comes down a lot, right? Unless you get, of course, some geopolitical thing that spikes the price of oil massively or something, and it's not, if the inflation rate keeps coming down due to slowdown in the economy, then that would be great for gold. What you need to understand is that gold actually does well in a disinflationary environment. So what Frank, you pointed out so rightly, is that if you see a recession, inflation is going to keep coming down. And if you see a soft landing, meaning the economy hangs in there, but inflation does continue to cool down to that 2% target, both of those scenarios are bullish for gold. And I guess where you have to always ask yourself is where can we be wrong about that idea, or where can that be broken? That concept, anything in markets, any game plan can have a weakness. The weakness, I think, for gold would be if from here you actually started to see inflation rise, meaning if the economy is just so airtight and the Fed needs to actually come back and talk about rate hikes again, that would be super bearish for gold. So Frank, you're dead on with that, with the recessionary fear or the soft landing situation. Both of those, I would say I'm in the same camp. Gold looks good, and I like your trend line point out there on the technical side. So gold, definitely an interesting one. I have another question too for you, Frank, on the COT data. Of course, we get this later today at the end of the day when we're about heading out of the office. We'll get the COT data. Is there anything that you're looking closely to out of the list the most?
I guess I just want to see a continuation of, I guess, what we're seeing now and maybe some minor changes. I like seeing the dollar sold, and then I like seeing, more risk on pairs on the long side. So we got AUD, CAD, Swiss, which is a risk off pair, but I think as long as we see dollar being sold, I'm gonna still have my bullish feeling on gold and the markets, and seeing that US 30 is still being bought up a lot. NASDAQ is moderate, but I want to see more risk on assets to the long side, and more dollar sells.
I think that's something also that you point out when we have streams and we talk about COT data. You always make that point. I think it's good that you're looking for the risk on collective to look good, not necessarily just one or two of the symbols in this list. So what I mean by that, and what Frank is talking about, is when you see the Canadian dollar and stock market stuff, and basically the risk on related assets, when they're doing well in terms of institutional money, like buyers from the institutional level are coming into those assets as a collective, that can be a really bullish signal on market sentiment. Again, because these are the professionals and what they're doing with their money. So if they're going into riskier stuff, that's a good sign for risk appetite. And if they're flowing into safe stuff and away from risky stuff, that can be a pessimistic sign. So definitely a good point on the focusing on kind of a basket of risk on versus risk off assets rather than just one or two. We've got PMI numbers coming out in 10 seconds to go here. We'll see if this does make any tangible difference in the story here today. 15-minute charts all around. Let's have a look here and watch PMIs. Okay, dollar index down here a bit. S&P pumping, gold pumping. Ooh, gold, hello. PMIs likely just came out cooler than expected. Yep, PMIs cooler than expected. Wow, 50.6, slowdown. There is more consensus-friendly data. Consensus-friendly meaning economy is cooling, inflation's coming down, rate cuts are coming. That number right there just helped us with that story. And there goes the dollar. It's fascinating. Markets are absolutely fascinating, guys. But that makes total sense. This move makes sense. PMI numbers showed cooling in the economy. Not actually cooling, by the way. 50.6 is still expansion, just a lot less expansion than expected. 52.5 is a good bit of expansion, the PMI number. For those of you who are not familiar with PMIs, a reading above 50 in the services department or services section is growth, and below 50 is contraction. So we have mild growth. Mild growth is in line with expectations, and actually stocks love this, I think. Let's see, am I right? Stocks are loving it.
Don't forget to check out the links in the description if you want our broker recommendation, access to our free Discord, free Edge Finder, or want to chat with us on Telegram. Remember, you can watch us live in the markets every morning starting at 9:30 a.m. Eastern Time, and we have lots more free trading tools and content available on our website, a1trading.com. Thanks for watching.